Our second type of source document for cash transactions is number 2, EFT receipts. And the best way to think about those ones is it's those pesky little things that get attached when you buy something in a store to your actual receipt. So what is an EFT receipt? Well, it's issued by the business when it receives cash from another entity, not in terms of physical cash, but in terms of an electronic funds transfer, e.g. online banking, or maybe if you use your card in the store. So we can see this is we're Cool Cardigans, and we issued this EFT receipt source document to a customer. So here's our name here. And there's, the little annoying extra little receipt you get sometimes, which is attached from the EFTPOS machine. And that's what EFTPOS stands for, Electronic Funds Transfer. So we can see here it's $80 plus GST. So we received a total of $517. What we can't see is like what was actually bought by the customer. And the reason why we can't see that is that would actually be in the cash receipt, which we did in the previous video. So, but we can infer here that we made a cash sale of inventory for $80 plus $8 GST to a customer. We don't know the name because it looks like it was an EFT card sale. And that happened on the 8th of February, which we can see here. The cost of sale was $40. Now we can't tell that from this document, but in the previous video we said Cool Cardigans applies a markup of 100%, so therefore the cost of sale must have been $40. The source document was receipt 517, so there it is there. In the real world it's usually a really long number because when you think about it, so many businesses issue so many of these every day. But in our case it's just 517. The main thing that we want to know is how would this go in the general journal? Well, this must be for a sale, and I know that because it's got GST on it. If this was a customer paying me back, it wouldn't have GST because that doesn't have our GST on when an account receivable pays me back. So this must have been a sale. So we'll start with the date, 8th of February, which is there. And I'm going to start with the cash or the bank, and that's an asset going up, and it's going up by $88 total. So when an asset goes up, that is a debit. The offsetting credits for that will have a sale. Sales are revenue, and the sale part will be this $80 here. The rules of debits and credits say when a revenue goes up, that would be a credit. But we've also got this GST because the business received two things today. It received some revenue of $80, but it also received a liability called GST clearing because our business has $8, but it does not belong to us. We're obligated to give it to the government. So therefore, that's a liability going up. And when a liability goes up, that would be a credit. Every sale must have a cost of sale. We can never tell that from the receipt though, because businesses don't give that to the customer. We don't want the customer to know what the goods cost us. So we have to infer it from knowing that there's a 100% markup applied to the sales of Cool Cardigans. So we'll start with that. That's a cost of sale expense. When an expense goes up, that's a debit. And we had to sacrifice inventory today to make this sale. And inventory is an asset. So when we gave up the inventory, that asset went down. And you can see the credit there. And we got all our debits and credits, so there's always 5 entries required for a sale. What we need to always finish with in the general journal is our narration, and we'll just say cash sale of inventory, EFT receipt 517.